Let's talk about the journey of the average trader. Why traders want to learn a trade? It's simple. Traders are lured in by the idea of being free and the promise of riches. And since the beginner trader has no idea where to start or how to trade, he naturally reverts to looking for tools to trade for him, indicators. And after realizing indicators don't work, another brand new strategy is on the horizon, and eventually frustration gets to the point where a trader decides trading is not for him. And I started the same way. Me and my friends spent countless hours and sleepless nights trying to figure out the best combinations of multiple indicators that would result being profitable. And of course, nothing worked, but I was convinced that I just hadn't found the right combination of variables of the indicators. I tried everything under the sun. Maybe if I just tweak this Tenkan a little bit more from 32 to 40, and if I just tweak the RSI from 65 to 45, maybe it will work. And what if I add Elliott waves, Fibonacci, and Bollinger Bands? They must be working since the internet is full of it, right? No, eventually I got rid of all the indicators and I just started looking how to trade without indicators. How to trade pure price action. What is price action? In simple terms, you just observe the pure price and analyze every single candle, every single bar without any clutter. To achieve consistent profitability, traders need to have an edge over the markets. It's simple. The more you're able to anticipate where the market is going, the better chances you have to make more money. Edge gives traders better odds over the market and allows traders to find setups with better success rate. And when you analyze pure price action and when you wait for your edge to form, you can take advantage of the markets. Okay, so what is the proper edge? Well, you must understand how market moves, where the major moves form, and you need to master major aspects of price action. The very first thing I need to do is I need to make sure I read the price action correctly. This is important. I need to identify the bias. Is the market trending? Where is it trending? These are the questions I'm always asking myself. Or is it sideways? If the market is trending upwards, my main focus is to look for long setups mainly. And when the market is trending downwards, my main focus is to look for short setups mainly. If the market is working sideways, well, I can trade it both ways, but I absolutely must have some level of understanding what is the structure of the market. I don't have to be perfect. You don't have to be perfect. It's important to remember that, but you have to be close if I want to follow price action properly and if I want to follow price action rules properly. So this is the first part of your edge. Second, you need to be aware of the fact that major market moves don't occur randomly. They happen at important places on the chart at key entry points. So if I want to predict where the major moves may form, I need to find the proper key entry point, which is either trend line, support resistance key level, or the exponential moving average. I only use one indicator as a supportive indicator only, and this is the 21-bar exponential moving average. It only helps me with my analysis of pure price action. I don't trade moving average crossovers, none of that stuff. So now that I know what's the main bias, and I know where the key entry point may be, I cannot just take any setup I like. In price action, some setups have high likelihood of succeeding than others if all the rules align. My goal is to take high probability setup only at key entry point under the right market context. And the high probability setup is a variation of the two-legged pullback, second entry, failed second entry, low high, high low confirmation setup, failed breakout, or double trap. I talked about these setups more in my videos in the beginner playlist. If all first three factors now align, then you need to make sure the behavior of the setup is correct. Meaning you have a good signal bar confirming your setup and confirming your momentum. That's important because sometimes the signal bar can form very ugly, and this is the sign for the market that the other side stepped in and you don't really want to be taking the setup because the signal bar is not confirming your initial analysis. I also need to make sure the setup is not congested because the congestion is indecision in the market and reliability of the setup decreases during price congestion. And that's it. You just decide if rules are being met and either take the setup or don't. Let's now take a look at the price chart and how would you use the edge that you've learned. The first thing I need to do, I need to ask myself what is the bias. And right now I can see that the bias is trading range, isn't it? Because there is no clear uptrend or downtrend. Well, I can see we have uptrend working, downtrend working, but we have move up and move down, and basically market didn't change much. And you can see that I'm already drawing these channels. And this is important because the price action is always following some pattern. These candles, they're never alone and naked on the chart. There's always a pattern working. And these channels are key entry points. So I always follow the price action and want to follow the price action rule. Because after there's a break of a channel, you don't reverse the market, you expect new extreme, and then after new extreme is formed, the market may reverse. So we have downtrend, we have a break, new low, and since it's a trading range, I'm going to identify the key levels. Okay, so more information from the market is being presented to me. And this is what I do. I just follow the price action and I just read candle by candle, bar by bar, trying to make sense what the market is doing. And this is what you need to do. This is what you need to train your brain to be focusing on. So right now I can see a very strong bullish spike, very strong spike, multiple consecutive bullish bars. First thing I'm going to do, I'm going to find a channel, find a key entry point so I know where the market is going, because chances are high that this market, this uptrend will not reverse. It will attempt to get new extreme if we get a break, okay? And notice what we have. We have a little break outside this channel. And now the question is, can I go long here? Because I expect new extreme, I expect new high. For this reason, I need to make sure I'm at the key entry point, which I am. I'm at the exponential moving average, which is the supportive indicator. And now I need to properly count the entry. Because remember, if I want to take high probability setup, it needs to be a variation with two-legged pullback or some other high probability setup. I cannot just randomly buy or sell just first entry or fourth entry. I need to count the proper entry, find a two-legged pullback, because it comes down to human psychology. If traders try something once and it fails, they usually try it again. And it's just how the price action is depicted throughout the years. So since I'm counting for longs, I'm going to count from the latest high. So this is the highest high. You can see bars working lower. And if you get a break above the bar, this will trigger the first entry. So we have new high, first entry long, it failed, and we have second entry long. And by the way, I have a video about how to count entries in my beginner playlist. So this is a second entry long. Is this a high probability setup? It is. Is the signal bar good? It's great bullish signal bar. Great tail at the bottom. All the cells got trapped, and at the close of the bar, everybody started buying. It closed above EMA, and notice I also draw the micro downtrends, because this is how price action works. There are also channels inside of the main channel. So the downtrend has a break new low, which is indicating to me that I can now think about buying again. So this is a second entry long. Everything is aligning. Structure is trading range. We're heading from the bottom, probably to the top. This bullish trend needs new high. So this is the shortened bias. Downtrend played out. It is a high probability setup. I can go long, and it created a quick scalp. Your stop loss goes one tick below signal bar, so you were never hit. And notice what we have next. We have a failed second entry short, because not only I'm counting for longs, remember, I'm counting for failed second attempts, but I'm looking for people to get trapped. And since the structure is bullish, because this trend is the shortened pattern, needs to get new high, I can count for second entry short, because the shorts are going to get trapped, going short on the wrong side of the market, since this uptrend needs to get new high. So from this low, I'm going to reset the count as a first entry short, pull back, second entry short. Signal bar is a little bit neutral. You can wait, but during failures, you can take aggressive signal bar. Now notice what we have. Another new high. I'm going to reset the count. I have first entry long, second entry long, horrible signal bar. I cannot take it. I have new high of the uptrend. But notice what's happening. Market keeps pushing higher. Brand new series of high highs and high lows. And the EMA keeps holding every single time. So this is a pattern in price action that is called a spike and a channel pattern, because we spiked up, we consolidated, we have a congestion right at the EMA, and this is typical how spike and a channel will a lot of times form. So this is a bullish structure still in the market. There are no signs of the bearish pressure. All the major buys right now in this market still is in the hands of bulls. So I'm still only looking for setups to go long, okay? And this is what I do. I just follow the price action bar by bar, looking for patterns, working with the EMA, counting for entries. So this is the key entry point, the main key entry point, spike and a channel pattern. And I have new high, first entry long, second entry long, great bullish bar. I'm going to put my stop loss below, and it failed. And it's okay. I'm not bothered by this. Nothing is 100% in price action. No trading strategy is 100%. If you want perfection, you have to choose a different job, because you will never achieve 100% consistency. It doesn't work. It doesn't happen. It is impossible, because these markets, they are controlled by the institutions. You can't move the market. You're a retail trader. Only thing you do as a retail trader is you follow the footprints of the big players. You follow the institutions, and the goal is just to take advantage, take a little piece of the moves they are creating. The central banks, the big hedge funds, the institutions, they are the ones who are moving the price. They're the ones who are pushing the market in the direction they want to push it. You can't push it. Average retail trader cannot move the market. You just have to follow the price action, follow the footprints, and take advantage of the market moves. So this second entry long failed. No problem. That's a part of my plan. I have a double trap, which is a high probability setup, a little more advanced, but at two key entry points, at the EMA and at the trend line. So this is confirming to me that buyers are still buying at two key entry points. Great bullish bar. I can go long, and you can see you can make it all back, quick, easy scalp. Now we have a break of a spike and a channel, which means I expect new high to be formed. okay? Because this channel is nicely confirmed, and after break, we expect most likely new high. We can reverse, anything can happen, but I don't try to predict the future. I just follow the price action and I trade the market I get, not the market I want. So we can see that we have small little congestion. This is what congestion is. It is a series of overlapping bars stacked right next to each other without any clear direction. And generally, you don't want to be trading congestion because there's a lot of whipsawing back and forth, and you want to wait for prices to break out of this congestion. Okay, prices are pushing back above the EMA, which is confirming our analysis that this uptrend is going to get new extreme. Great bullish bar, and this is a high-low confirmation setup, and market created new high. Notice what we had. Strong bearish reversal down, followed by a instant bullish push back above EMA. Okay, so we can see that this is what sellers did, and they didn't even manage to go all the way to the support. They bounced in the middle of the trend range, and we are back above EMA again. And now we have new low. First attempt to sell, pull back. Second attempt to sell, failed with a very strong bullish bar. So right now, this is giving me information that the bulls are still stronger in this market, and I don't want to be thinking about selling above EMA. In fact, we can see, okay, prices keep pushing above EMA in a brand new series of high highs, high lows. And EMA keeps holding again. So I need to, once again, count for long entries. Notice we have a new high, first entry long, second entry long, horrible bearish bar far away from EMA, and we have double trap. Can I take double trap? Even though it survived, I cannot. Why? Because I have downtrend in play. If I want to go long, the downtrend, the bearish correction needs to play out. That's the safest way how you're gonna make sure that your odds are increasing, that the setup may work. I want to see the bears deplete first with the break, attempt to create new low, and then I have high-low confirmation setup. EMA keeps holding, and notice your stop loss was never hit. Once again, one tick below the signal bar. Very strong bullish push. I have a brand new key entry point forming. I have a new high, first entry long, second entry long, and market kept pushing higher. Of course, here I would arguably drew a downtrend, or it could have been a little bit tighter. At this point, the bullish move is quite strong. This trade can be skipped, or it is more aggressive. But this is what you do if you want to find the proper places where to enter on the chart, because you cannot move the market. You just follow the institutions, you follow their footprint, and every single bar is telling you something. The brand new higher high and brand new higher low is giving you information where the market is going. You're looking for key entry points. You're not being emotional. You're being patient, and you just wait for market to form as your edge is dictating. The only indicator I have on my chart is a 21 bar exponential moving average. The price action reflects human behavior. It reflects human greed and fear. I don't need any volume profile, order flow, stochastic, MACD. The price action alone can tell me everything I need to know if I just analyze it, watch where the market is going, and analyze every single candle. It's not fancy, there's a bunch of fancy indicators promising you holy grail, but you should have at least some level of understanding what you're looking at and where the market is going. It only makes sense to be aware and understand what you're trading, what is the instrument doing, and where the moves will most likely form. That doesn't mean that you cannot use additional supportive indicators like we have on the right to help you while analyzing the price action. Of course, any trader can use and implement different ways how to analyze the price action, but you should have at least some sort of understanding what the price action is doing and where the price action is heading. The rules of price action work in all markets. When I put different charts in front of you, you're not going to be able to tell the difference between chart from today and chart from 10 years ago. Human nature doesn't change. Price action is a reflection of human behavior, and it is in our genes. We have 3 different charts, but we can see there are all 3 different instruments and different time frames. We have USD JPY 5 minute, we have the S&P ES 1 minute chart, and we even have Procter & Gamble, the weekly chart. And you can see there are similarities to all these charts because price action is still following the same rules in all markets and in all time frames. You're going to apply the same logic of price action when you're trading every single different instrument. Your approach to the market should always be the same. You should always look to mark your chart up. You should always look for key entry points and for high probability setup. It should be a routine for you to be consistently marking your charts and looking for the proper places to enter. We can see that we have first 2 swings that allow us to identify a possible key entry point, and third swing confirmed it. So the structure of this market is bullish, and I need to follow my plan. I count from the each new high because I'm counting for high probability setup. I have a second entry long, but it is far away from EMA. It is not at the key entry point, which means according to rules, I cannot really take it. Even though it worked here, next time it may not work. We have double top, count reset, and notice we have the 2-legged pullback confirming the trend line, downtrend played out, and we have second entry long at the key entry point with a great strong bullish signal bar. So this is where I'm going to decide if I want to enter, how much I'm going to risk, what is my target profit, where I'm going to put my stop loss. My stop loss goes always one tick below the signal bar. And why am I using stop loss? Because I don't want to argue with the market. If my analysis is wrong, I want to get out as quickly as I can, take the minimal hit, and look to re-enter on the next one. For this reason, I'm just going to bet that my analysis is correct. In case market goes and stops me out, then market is probably reversing and I analyzed it wrong. So we have a two-legged pullback, strong push above EMA, and high-low confirmation setup of two key entry points, and you can see the price action is indicating to you that the market is losing steam, is losing momentum. Prices are no longer making it all the way to the trend channel line, but you can see they're barely making it to the midline. So there's a loss of momentum. Every single detail is being told to you by analyzing pure price action. We have a break of the channel, which means we expect new extreme, new high, first entry long pullback, second entry long, two-legged pullback, and the downtrend played out with the break and new extreme. So you can see the same rules we used earlier can be applied on the USD JPY 5-minute chart. And here we can see the ES 1-minute chart. We still have first couple of swings at the bottom, allowing us to identify the channel. The channel is getting confirmed here, channel is getting confirmed here. So I have my bias, I have my key entry point, and I'm just counting for high probability setup. We have another two-legged pullback, first entry long, second entry long, downtrend played out with the break, new low at the key entry point. Always look for opportunity to buy when the structure is bullish. Wait for a setup that follows your edge. Once I see market working higher like this, I'm not chasing the market. I don't care that the market is going higher. Market can go higher 50, 20 points, 50 points, 100 points. I don't care. I can only follow my plan and enter while prices will pull back and will make their way to the key entry point. Another two-legged pullback, another second entry long at the key entry point, and another second entry long at the key entry point, followed by a break, high-low confirmation setup, a new extreme of the market was formed. And I'm a scalper, so I'm mainly interested in small price action moves. This works in all time frames, but I like to be in and out of the trade fairly quickly, and I like the idea of being able to predict a very small move in price action. You should always start by identifying the bias and identifying the key entry point. That should be your habit that you need to learn. It should be a routine. You're not placing a trade unless you successfully identify what the bias is and where is the possible key entry point. As you watch price action develop long enough, you will develop a sense, a gut feeling that will help you to navigate through prices easily, and you'll be able to predict where the prices are going to go on a more reliable, consistent basis. But it takes time to get used to it. You need to train your eyes to see the price action develop, to see the candles print and market moving. You should apply the same market approach to every single market, because the price chart is a map of interaction between buyers and sellers. The first thing I'm going to ask is, what is the bias? We clearly see that it is a bullish market structure, which means I'm only looking for high probability setups to go long. I have my key entry point, and at this point on, I'm counting for second entries because I want to know when the high probability setup, which is the two-legged pullback, may appear. The high is high, two-legged pullback, and a second entry long form at two key entry points, and market continue working higher. You can see that there's a reason to price movement, and all these big moves happen at certain level. And that is because in every single market, there is a push phase of the trend and correction phase. The buyers have to take profits, and the sellers, the beginner traders especially, are picking tops trying to reverse the market. But you never want to trade against the main trend. You always follow the trend, and the best opportunity is to wait for prices to deplete the bearish momentum and then jump on longs again. So this is where the correction phase is ending at the very key entry point, and a high probability setup appeared. Another second entry long with the break new low of the downtrend, followed by a high low but a horrible signal bar. Market continues working higher, and another two-legged pullback at the important key entry point, and market continues working higher. There's actually even a high low. So you can see we went over 3 different price charts, 4 in total, and you can see there's still the same behavior to prices. We have larger two-legged pullback, market likes to move in pairs of twos, and according to price action rules, you're not expecting reversal. Just because you see this bearish sell-off, that doesn't mean you expect for market to suddenly reverse. It can, anything can happen, but you're more expecting, since it resembles two-legged pullback, still to expect new high, especially if you have strong push above EMA, which is confirmation of the bullish momentum. then you know by this strong push above EMA, multiple consecutive bullish bars, the ladder bars are buying and the new high is most likely going to be reached, followed by a high probability setup, new low, first attempt to sell, pull back, second attempt to sell, that failed. When you're trading, you want to be patient. You don't want to be over trading. You don't want to be consistently looking for setups on every single candle. Instead, you want to lay back, let price action to develop in front of you. And once you see price action approaching your key entry point, this is where you start paying more attention because you've analyzed the context correctly. You got your key entry point confirmed. And now you see the setups forming. This is where you start paying more attention if the signal bar is good, if the setup is congested or not. Think about it as your predator just hiding in the bushes, waiting for prey. You're not running around consistently looking for every single setup and over trading, because if you keep over trading, if you keep mixing the rules, if you're antsy to take a setup, if you're frustrated, you will never really progress. You will be stagnating on the same place because you will never teach your brain to look for the same pattern, to follow the price action rules, to follow your trading plan. You will never reinforce the good trading habits and trading skills and overall mental fortitude. You cannot allow your emotions to get ahead of yourself. You cannot trade impulsively. You cannot rush trades. You cannot overreact. Trading should be boring. It should be mundane. It should be a routine. You really shouldn't be that excited when you have a winner, and you shouldn't be upset when you have a losing trade. This is all part of trading. Your goal is just basically try to follow the rules as best as you can and just bet that your statistical edge in the long run eventually will be good. Trading is a skill like anything else, and it requires practice. You need to study and practice. Traders are convinced that studying the charts after the fact has no benefits, but I guarantee you that almost every single profitable trader you know studied their charts after the fact. They're back-tested. And think about this. Every single profession in the world basically starts with practice. Doctors first use simulations and fake accounts before they start performing operations on live patients. Pilots first get into simulators before flying a real plane. If you're a boxer, you don't just jump straight into ring against another professional. You spar, you train with heavy bag, etc. And basically trading is the same thing. How do you practice? Well, you have to take your chart and print it at the end of each day. Mark it up with setups, look for patterns, think about how you would have traded it, what you could have done better, how you would have drawn your key levels, all these things you want to go through, because with time you will start seeing more similarities in price action and quicker you will be to react. Studying your charts after the fact will help you speed the learning curve, and you will be able to understand price action quicker. You need to follow your trading plan. Trading plan is important because most of the trading is mental, and we need to constrain ourselves from doing something we shouldn't do. First, you need to make sure you're comfortable. Make sure you're in a positive, comfortable environment. Find what makes you relax and follow this routine. Whether it is making a tea or coffee, I make my tea every single day before every single trading session at almost the exact same time. It's basically become my routine. The goal is to leave all the distractions outside, because traders, especially scalpers, they need to be in the zone. As a scalper, you need to be ready to observe every tick and to catch any little price movement. Sometimes you look away for 2 seconds, and if market is fast, you miss a setup, and you cannot afford to be distracted, uncomfortable, and frustrated. All details in price action are important. And that's why sometimes when I was starting out, I skipped this very first step. I came in late, I sat in front of the screen, and I quickly opened up the charts and I rushed my analysis. Why? Because I was too eager to trade. I couldn't afford to miss one day, and this oftentimes led to me not being fully objective and not wanting to miss a setup and drawing channels too wide while ignoring a break in a new extreme, resulting into a losing trade. At this point, I would never allow myself to do this again. I was burned so many times. If I'm running late, no matter what, I will not trade the first couple of minutes after opening my chart until I cool off and I'm comfortable. Set your goals and expectations. Now this is different whether you are a very beginner or already advanced trader who is trading, let's say, micros, ES, or planning to transition live, because beginners can afford to take more trades in order to learn about the price action and discover their tendencies. However, even beginner trader should plant seeds of the proper mindset and approach early, because if you treat trading like a job from the very beginning, transitioning life is going to be much easier. Set your goals. How many trades per day do I plan to take? When do I take breaks if I don't find setup early? When is my cutoff point? Am I okay with not making any money today if I don't catch a good setup? All these things you need to be prepared, because the last thing you want to do is you want to chase the setup at the last minute hoping you will make it up. You have to have realistic expectations. With time, you will discover which routine fits you the most. Maybe you're tired for the day and you don't feel like trading. Market is not a good arena to bring these feelings in. When you have issues in real life, perhaps just say to yourself, I'm not in the right state of mind and I'm not going to risk my money, and I will sit here and watch it just to get experience. I will not trade, but just watch the market just to get experience. And after an hour, you may discover you feel much better and you are in sync with the market. I used to trick my mind in a similar way when I didn't want to go to the gym. I was feeling tired, didn't feel like working out, so I just said to myself, all right, I'm just gonna go to the gym, do some light exercises and go home. I was trying to trick myself and lie to myself like that. But when I got there, I saw all the people training, I saw the atmosphere, I suddenly felt pumped and I got excited to actually do the heavy workout. Same thing with trading. Maybe you're just going to watch for a few hours and suddenly you will realize you're ready to take trades. The goal is to recognize your state of mind and to be fully objective. Next, proceed with the pre-market analysis. Before trading, make sure you know what is the pattern and what is the bias. Ask yourself, do I actually understand what's going on? And sometimes you don't. If you're fully objective, you don't. That happens a lot. Bias is not clear. There are multiple patterns conflicting. So just wait for the market open and just follow the price action after the open. It's important to be objective. You cannot really try to gamble or try to rush things. It's very normal that there are multiple patterns working together. You have conflicting beliefs, so just wait it for the market open, and eventually after the market open it will pick up and the analysis is much easier. Also, have a predetermined plan how to deal with frustration. After some time, you will become familiar with yourself and you will recognize patterns when you self-sabotage. It is paramount for you to stay objective and true to yourself. You cannot let your need to make money for this day to force you into doing something you shouldn't do. After losing trade, you may get very upset. If that happens, you need to take a break, get up and walk away for 5 minutes, and you will be amazed how clear the chart looks after such a small break. It's really astonishing because those negative emotions are building up and you need to get out, you need to take a break, and once you come back, you clear your head and you're able to follow the rules again much better and with ease. And sometimes you may be too overly attached to wrong bias despite the market showing you different clues that the bias is changing. This is also happening a lot. You really don't want to admit that you've been analyzing a little bit wrong. The market is giving you information that the bias may not be as you first analyzed. You need to be objective, and for this reason, small break here and there is absolutely crucial because that can kind of help you snap back out of the cycle and be more objective. Good luck with your trading.